Good afternoon and welcome to RAP's final webinar of the year. My name is Damali Harding and I am the U.S. Program Director for Regulatory Assistance Project. And for more than 30 years, RAP has had a vision to create a clean, reliable, equitable, cost-effective energy future for all. We offer a data-driven approach to the future of energy. And if you aren't familiar with RAP, you can find out more about us at www.raponline.org. Today's topic is utility performance incentives, with primarily quantifiable outcome-based measurements that translate into financial rewards or penalties. These can be designed to address specific priority areas such as better reliability, reduced low-income customer arrearages, fewer interconnection delays, or accelerated energy investment. Today, we are joined by Mark LeBel, Senior Associate at RAP. Mark has more than a decade of experience working in the overlapping economics of law and energy and environmental policy in the U.S. and is a Senior Associate at RAP. We are also joined by Steve Kihm. Steve is the regulatory strategist at the Citizens Utility Board of Wisconsin, and he has worked in the field of utility regulation since 1980. He holds a Doctor of Business Administration degree and is a chartered financial analyst. Lastly, we are joined by Rich Sedano, President and CEO of RAP, and Rich brings decades of experience and industry regulatory experience to this webinar and to RAP. In today's session, we're going to review three key areas in performance incentive metrics: policy, legal, and financial. And then we will leave ample time at the end for Q&A. And if you have time, we will stay online for an additional 30 minutes for a further in-depth discussion. All right, next slide, please. All right, so 4 questions. So again, thank you. Many of you submitted questions with the registration, and we will try to address those. But if you have questions that come up during the webinar, please use the Q&A function. You should see that. And those questions will go to panelists, and we will try to get through as many as we can. Note that this webinar is being recorded, and everybody should be on mute. All right, so next slide, please. All right, so when I was in business school, professors told us that shareholder value was paramount, right? We asked for public companies. And so as we often do at RAP, we asked ourselves, what could we do to get an investor-owned utility to strive for public interest and not just maximize shareholder value? And so we spent the last year analyzing a framework of thinking about what motivates utilities for public good and what that might look like. And we came up with our most recent white paper. The authors are, again, Mark LeBel, Jessica Shipley, Steve Kihm, Makalia Kaliche, and Pete Kappers. And this white paper, along with our vast library of webinars, white paper, and other things that might be of interest to you, is again available on our website for download now. And so as we move through the approach, again, as I mentioned, we're going to take 3 approaches. One is thinking about policy. We'll do a deep dive into a policy framework and how that can address known challenges with a cost of service rate making approach. Second, we'll analyze what legal limitations exist for a performance incentive approach, either with rewards and or penalties. And lastly, we'll do a further analysis of what motivates investor-owned utilities financially and how performance incentives either creates or can create additional motivation for utilities to take different actions. All right, so one possible solution is, again, thinking through performance incentive metrics. And again, while overall revenue may decrease, there may be an additional shareholder earning potential with this additional incentive ideas. Lastly, today's key takeaways that we hope you walk away with from this webinar. One is a holistic approach of how you think about performance incentive metrics. Second is that a reward or penalty must be significant enough to be able to influence the desired behavior. Next is that shareholder value will always be a significant driver or a critical driver for utility management as they think about decision making. Never neglect to understand the legal requirements for incentives or penalties. And then lastly, excess return on equity is another key driver that allows for rethinking traditional utility rate making models. And with that, I am going to turn it over to Mark LeBel to start talking about policy in the context of performance incentive metrics.
Hi, thank you so much, Damali. Thank you to everyone for being here today. I also want to thank all of my co-authors and Steve for being with us today. We're all very excited to put this out into the world and spark some new discussion. I'll be starting off with the policy context of performance incentives. This graphic shows the 3 steps of traditional investor-owned utility rate making. While this is specific to vertically integrated electric utilities, most of it applies more broadly. In the context of performance incentives, we are primarily concerned with the first step, the determination of the revenue requirement, but nearly every aspect of the traditional cost of service utility rate making and regulatory model has given rise to concerns and debate over the years. Importantly, for our PIMS discussion, we're highlighting here the rate of return element of the revenue requirement formula. Depreciation is expense, as well as net rate base times the rate of return, is the return of and on capital investment. The rate of return itself is a weighted average using the formula shown here. The return on debt is typically less controversial given that it is directly observable. However, the return on equity has deeper complexities, particularly given the development of equity markets and finance innovations over the past century. Of course, utility management do try to be attentive to the desires of their regulators, policymakers, and the public, but over the decades there have been many documented failures and numerous more general concerns with utility performance. These concerns are often interrelated, and a complete list could be quite long. Many of these flaws can be traced back to different aspects of traditional utility rate making and regulation. For example, it's the rate structures that give rise to the throughput incentive to increase sales. Capital bias is another frequently cited flaw built into cost of service rate making, but it's important to be careful about the nature of that. The original Averich and Johnson article specifies that you would only expect capital bias if the rate of return is higher than the actual cost of capital, something that is not highlighted frequently enough. There have been many proposed solutions to utility regulatory issues over the past several decades, and a full list, once again, might be longer than the list of underlying concerns. But these solutions generally can be divided into 2 categories. The first is rate-making solutions, such as decoupling, which addresses the throughput incentive for utilities to increase sales. The second general category is structural reforms. This can include planning measures, but extends all the way to the introduction of competition and market restructuring. Performance incentives has both structural aspects, such as the actual recording of data and reporting of the data, as well as rate-making aspects, where you recover the incremental revenue or assess the financial penalties. And there could be many different versions of performance evaluation and incentives. This starts with informal monitoring, which utility regulators have been doing since the dawn of regulation. From there, we have formal data tracking and reporting requirements, which could be shared and distributed in different ways. It could be in rate cases, it could be directly to commission staff and parties, but it could also be more routine and public on a dedicated website. Next, you can have goals, targets, and rankings for the tracked data without any money at stake. And last but not least, you have performance-based financial rewards and penalties. In our report, we focus on outcome-based performance incentives and not shared savings or earnings sharing mechanisms because there are some important distinctions. Performance incentives date back over 40 years by now. Many of the early performance incentives were for generator availability, reliability, or customer service. In the 2000s, performance incentives for energy efficiency became common. Rigorous evaluations of performance incentives have not been as frequent, and the results of those evaluations have been mixed. It's important to note that counterfactuals are quite difficult in this area, and with small PIMs, you'd only expect small impacts, which may be difficult to measure. There have been a number of new efforts in the past decade on more cutting-edge topics, notably New York Rev, Hawaii, Illinois, and a few other states. As these initiatives are fairly new, they have not yet been comprehensively evaluated. We have some data from New York, but it's still quite limited. The promise of outcome-based performance incentives is that you encourage utility management to pursue the relevant outcomes without managing exactly how it gets done. But to date, performance incentives have largely been small add-ons to existing rate-making structures, either rewards or occasionally penalties, particularly for reliability. In some cases, they are symmetric rewards and penalties. There are a couple cases where there have been larger incentives, such as energy efficiency programs. Next, we need to consider the legal constraints on rate making generally and performance incentives more specifically. Procedural and evidentiary requirements do exist in every state. We include them here for the sake of completeness, but these do not typically have a strong influence on what kind of performance incentives can be implemented. The most common substantive legal requirement in every jurisdiction is for just and reasonable rates. This standard typically allows broad discretion to commissions to balance competing interests in rate making. As a general matter, this standard does not allow judicial review on the grounds that rates are generally too high, but courts have found specific rate-making elements faulty for more narrow reasons. Importantly, the bottom limit of the just and reasonable test has been found to be identical to the constitutional takings test and does not provide any additional protection or revenue for utilities. And that brings us to the takings clause of the federal constitution and similar provisions in state constitutions. The general idea is that if utility rates are too low, the state is taking the utility's property without just compensation, and it's confiscatory. In 1898, the Supreme Court ruled that fair value, including a fair return, is the touchstone for this requirement. But later on, Supreme Court justices pointed out that this didn't make too much sense. When we're talking about the government taking a piece of land, fair value makes sense, but not so much for rate regulation because the value of the assets depends on the rates allowed. Justice Brandeis in the 1920s articulated a different theory, that it's capital invested in the enterprise that is constitutionally protected. In 1944, in the Hope decision, the Supreme Court essentially adopted Brandeis's view and abandoned Smith v. Ames. Importantly, this enabled, but did not require, cost of service rate making as a more flexible approach, where the courts would look at the end result but not apply significant scrutiny to the methods. Under Hope and the previous cases, Bluefield, Southwestern Bell, among others, the requirements for the minimum permissible equity return have been summarized as comparability, creditworthiness, and capital attraction. Overall rates must include reasonable allowances for expenses, or else that requirement for a fair return is meaningless. And then the Hope decision itself was importantly reaffirmed in an opinion by Chief Justice Rehnquist as recently as 1989. Now, with respect to PIMs more specifically, we came up with 4 high-level takeaways. There have been a number of other relevant opinions since Hope. That includes Market Street Railway in 1945, Permian Basin area rate cases in 1968, and Verizon in 2002. First, the end result and the overall impact is what matters, and that there is significant flexibility in the methods allowed. The standard for capital attraction is consistent with the notion that a constitutional minimum is a return that compensates investors for the risks they are taking and nothing more. Third, the standard for comparable returns is not something specific to utilities or rate-regulated entities, but rather a broader comparison across the economy. And fourth, shareholders are not given absolute protection from poor utility management decisions or adverse changes in markets. And with that, I'll hand it over to Steve Kihm to talk about the finance issues.
Thanks, Mark. So these are 2 foundational sections. Mark has laid out the legal foundation, and now I'm going to talk about the financial foundation. So this next section will form the foundation for the improvements in incentive mechanism design. So this presentation may be a little bit surprising to many people. We use an investor focus, a corporate finance focus, and things in regulation. And regulation is a mix of policy and finance, and so sometimes these things get let's just say there are disparities. We're going to discuss several research studies that point this out, or they're in the report if you want to read those. But because regulation is this sort of this mix of different objectives and perspectives, we've kind of masked the value creation model. Molly talked about shareholder value, and that's actually really that's the focus that we use when we look at finance, is shareholder value. And the way regulation works, we don't really have a shareholder value model, and without a valuation model, it's actually difficult to evaluate incentives. So we are bringing into regulation a valuation model, and along with it, all of its bells and whistles that allow you to see how things work. So that is, and if you don't have that, it's difficult to see what's going on. Now, this is perhaps the most important point. It sets the structure for us. The return on equity and the cost of equity in regulation are often treated as synonyms, but that's actually not true either conceptually or numerically. We can show that fairly easily. Notice that the return on equity is something that is the utility's property. It's earned by the utility on its books. The cost of equity, you can never find the cost of equity looking at a utility's books or looking at financial statements. It's what investors expect to earn on the stock. So these two returns affect different entities, and they're measured in different ways. And the ability to capture value is actually a function of the difference between these two returns. If they're the same return, then no value is created. So I'll provide an example of that a little bit later in this presentation. Now, the cost of equity serves a couple roles. The other thing that, in addition to being the expected return on the stock, it's also the return investors require to buy the stock. It serves multiple purposes. But here's a key aspect that's often lost in the regulatory proceedings. The only risks that matter are not the risks to the utility. It's the risks that the investor faces, and because investors can diversify a lot of risks away in portfolios, the relevant risks are actually much lower than many people think. And so that allows the cost of equity to be lower than, and we'll see that the investment community uses lower costs of equity when they value stocks. But the whole idea, and Mark mentioned this, to create value, the ROE must exceed the cost of equity. That's really an important point. There's no capital bias simply because utilities can make returns on assets. It's that they can earn returns in excess of what investors require. And that's a key aspect of the design. So here are, if you look at these three points, the return on equity, cost of equity are distinct. It's the difference that drives those returns. But here's where we can use some analysis to show, and we'll present some data on this, that ROEs actually are above the cost of equity. Even though almost every regulatory order says they're set equal to it, this investor perspective suggests that's not true. And again, we're not the only ones that say this. The report is replete with studies by many people that say that. Now, it's not a problem that some utilities earn ROEs in excess of the cost of equity. In fact, that would be good. The good performers should earn returns in excess. That's what performance regulation is all about. The problem, and Alfred Kahn pointed this out in his classic text, The Economics of Regulation, essentially regulators give everybody a premium return. And that is a problem, because then you don't have to perform to get the extra return. So that is what we focus on, is that the performance reward should not be available to all utility stocks above the ROE. And we have a nice principle that we can look directly at the utility stock price and its book value, and we can tell whether the return on equity exceeds the cost of equity. And this is why the investment community sort of reaches the universal finding that ROEs are above the cost of equity. Why? Because utility stock prices trade at substantial premiums to book value. The only way that can happen is if the ROE the utility is expected to earn exceeds its cost of equity. So now this leads us with some choices, a package or bundles of things we can decide to embrace. But there are some logically inconsistent bundles. But here's one bundle. The commission sets the ROE at the cost of equity, and the utility has no incentive to invest capital. Those have to be linked. You have to conclude both of those, or you can conclude that the utility has an incentive to invest capital because returns on equity are set above the cost of equity. But here's the bundle you can't have. Regulators set returns on equity at the cost of equity, and investing capital creates value for investors. That is a logically inconsistent point, and that's back to Mark's point. That's not what Averich and Johnson said in their article. It's that the ROE has to be higher than the cost of equity. That cost of equity is a minimum threshold. Talk about sort of that basement constitutional idea that Mark just talked about. And so, but we often hear rate of return witnesses say directly that this ROE is set at the cost of equity, and this creates an incentive for utilities to invest. That is simply inconsistent with finance principles. It cannot be true. So let's look at a real example here. This is Xcel Energy. So Xcel's invested capital, recorded over time, is the equivalent of $32 a share. But investors pay $61 a share for the stock. Well, think about that for a minute. What must that mean? Why would they bid up the stock? They don't have to bid the stock price up to almost twice book value, but why do they? Because Xcel makes returns on equity that are noticeably higher than the return investors require. That's true for essentially all utilities, and it has been true for many decades. Again, that is what the research shows. The data is clear here. If the utility were earning just its cost of equity, Xcel would trade at $32 a book value, and it would trade at $32 per share book value, and it doesn't. It trades at 61. And so what happens is that as the investors were to, if we wanted to think about this done in real time, so we'd jump in and we'd see a return on a $32 book value, and it's attractive. So we're going to start bidding that up. We're going to try to get a piece of that action. And that every dollar above the book value that we bid the stock price up dilutes that return. And where does it stop? It stops when that price will produce a return equal to the one investors require, not the one the utility earns. This is going to be really important. We're going to talk about this over and over again. Investors don't earn ROEs. They earn costs of equity. So this process of pricing continues until that diluted return gets to the return that investors require. Now, you don't have to take you don't have to take LeBel, Shipley, Felice, Kappers, and Kim's word on this. This is actually manifest in just about every investment report that you would look at. So this is from Morningstar for Xcel. Now, this is a recent report, December 2023. And notice what they say. They say exactly what we say. The ROE, or put it this way, the cost of equity must be lower than the ROE. That's the only way you could explain a stock price well above book value. So and these are long run, this doesn't mean next year or something. These are long run projections. The ROE of 9.5, cost of equity is 7.5, 200 basis point difference. When Morningstar puts this into its proprietary model, it gets an estimated value on the stock of $59 a share. The stock trades at 61. So this is actually following the mechanics of the market. But notice that's 200 basis points. That there's no investor group that would say that utility returns on equity are equal to their cost of equity. That can't be true with utility stock prices exceeding book value. And this has to be the case with that relationship. So this is now putting this whole process into we've deconstructed it. Using the Morningstar analysis, those first two is where the cost of equity is. That's where all the risk resides. That's where all the relevant risk resides. So that'll get, if you compensate, go back to one of Mark's slide, which is if you just compensate them for the risks investors face, Morningstar says that's 7.5%. Regulators allow a 9.5% return. What's that extra 2 percentage points? Well, it has nothing to do with risk. What does it have to do with? performance. That's what it should do. But in regulation, we mask this. We say, oh, that's the cost of equity, that the 9.5% is the cost of equity. And so we're not seeing that basic value creation process. Now, back to this 7.5% return that might be the result of, for a utility that's not performing well. We're saying that you could set there. Again, we're not saying that all utilities ROE should be set at 7.5%. That's not at all what we're saying. But if you're a pure performer, what if the regulator set the ROE at 7.5%? What would happen? Would the utility be able to attract capital? Well, this quote from Higgins, Koski, and Minton tells us that's not going to be a problem. Why? Because investors don't earn ROEs. The only way you could earn an ROE is if nobody else knew what the ROEs were going to be, if they were unknown, which is really interesting. If they're unknown, then you could capture benefit. But once they're known, the market will price utilities at the various ROEs to produce the same return. New investors will earn the same return, whether their cost of equity or the return on equity is 7, 8, 10, 12. They'll be priced to produce the same return. This is the melting away in higher stock prices. And the only reason that wouldn't occur is if you had inside information on the ROE. That's never going to happen with utilities, and it doesn't happen very often for any utility. It's certainly not going to happen with utilities whose ROEs are set in a public forum. So back to this picture, what does that mean? Well, investors are not expecting 9.5. Why do we know that? Because they would only pay $32 a share for Excel. The fact that they pay 61 means that they're going to be pushed down to that 7.5% cost of equity. Again, this is really quite clear if we look at this like an investor does. But again, seems contrary, where regulation typically says ROEs are equal to cost of equity. So you have to kind of break away from that conventional view if you're really going to understand this. So here's the Higgins, Koski, and Minton. By pushing the stock price up to 61, that 9.5 is melted down, using their terminology, melted down to 7.5%. And that's going to be the same return you're going to expect on just about any utility stock today. So notice how this works. So let's say there's a utility that has a high ROE, an ROE is pushed to 12, very high. Well, what happens? The stock market immediately will price that stock well above book value, and there's a timing issue here. Utilities don't raise capital every day. They raise it in lump sums just over time. And so when they go to market to raise new capital, this is what capital attraction, that stock price is quite high. Well, the new investors, that actually dilutes the return that the new investors, and it dilutes it all the way down to 7.5. What about a utility that has a very low ROE? Well, the market will notice that again, and it will price the stock at or maybe slightly above, but about book value. So when it goes to raise capital, there's no premium, there's very little dilution. In the end, the new investors get 7.5. They get the same return. This is capital attraction is not a problem for utilities. It's not related to ROE. Financial markets will allow utilities to raise capital at nearly any ROE. That's not a problem. But and this is because investors expect to earn costs of equity, not ROEs. But that doesn't mean that the ROE isn't important. It's critically important, and it's important to a different group of investors, the ones that really matter, which are the existing investors. I talked about the stock price moving up and down to melt away that return on equity. Well, who bears the consequences of a stock price going up or down? The existing investors. So this is where the opportunity, or we should be focusing on, is the value of the utility stock. So incentives create opportunities to push the stock price higher. Who's going to benefit? Not some investor that'll come down the road. That'll be too late. It'll affect the existing investors, and that actually is the group that utility managers have no fiduciary obligation to somebody who might buy the stock. They have a very strong fiduciary obligation to those who already own it. So this is why the valuation frame is so important, because we're looking at how an incentive might affect those who already own the stock, the existing investors. It's not about attracting capital. And so that's where our financial lens should focus. And with this financial lens, what should it be about? Well, the premium above the cost of equity should be based on performance. So this whole incentive frame fits nicely into this institutional investor perspective where there's a return risk premium and a return premium. It fits in very, very well. So with that, I'm going to hand it back to Mark.
Thank you, Steve. Now we need to talk about tying it all together and integrating performance incentives into rates. There are several different overarching considerations. First, you have to think about how much can incentives change utility behavior, and you need to look at the costs and benefits to the utility. In particular, for example, you need to understand the size of the capital bias if one of your goals is to overcome capital bias. If you have a big capital bias, it's like pushing a boulder up a hill. You need a lot of force to overcome gravity. But if capital bias is small or non-existent, it's more like pushing a boulder on flat ground. You need a lot less force. Now, there's also a question of whether there's underlying culture issues at the utility, whether there's institutional concerns or just inadequate training or other more systemic issues. But sometimes the economics of the situation and the culture are often interrelated. When you're putting all of these pieces together, ideally, you try to find a triple win: a better deal for consumers, better achievement of regulatory and public policy outcomes, and net financial benefits for well-run utilities. Not necessarily all utilities, but particularly for well-run utilities. We suggest a four-step process. First, determine the market cost of equity. Second, set base revenue levels for expected performance. Third, identify your policy goals, outcomes, and detailed metrics. And then fourth, set your specific incentive formulas. In the first step, there are unreasonable and reasonable ways to determine the market cost of equity. The technical terms for this is discounted cash flow or capital asset pricing model, sometimes risk premium methods. But there are some methods that clearly do not properly estimate the market cost of equity. Many analysts and regulators have been fairly clear that the comparable earnings method, we use proxy groups of other utilities or other companies, does not create an estimate of the market cost of equity. And it's important to note that you can do any analysis badly. If you use unreasonable assumptions in the discounted cash flow model, you're going to get an unreasonable final estimate. Next, you have to set the base revenue levels for expected performance. The base return on equity can, in fact, be a separate determination from the market cost of equity. However, this may determine the amount of capital bias to expect going forward. The base revenue level can be thought of as earnings with expected utility performance, and the performance incentives, whether they are rewards or penalties, operate around this expected earnings level, performance level. Last, you must consider how the application of rewards or penalties impact the legal permissibility of the base revenue requirement. A low base revenue may rule out large penalties, but also a low base revenue could be cured by significant positive rewards. And when you're actually thinking about how low you can go on base return on equity, it's a lot like limbo. You probably shouldn't try to limbo with the stick right by the floor. You're only going to hurt yourself. However, it is pretty clear that you can get under the bar at the market cost of equity. In between, there's some interesting questions. Can you get under the bar at the cost of debt? Maybe, particularly if you have significant potential rewards for the utility. An important part of the process in any jurisdiction is going to involve all sorts of stakeholders and good public input. Each jurisdiction needs to identify what policy goals they care most about, prioritize specific outcomes to achieve those goals, and then create the specific metrics that are data that can be easily tracked and reported. Sorry, this was supposed to be an animation, but did not end up working like that. But the final takeaway here is really that we need to think about how to put things together as an overall package. Um, there, the traditional model of utility rate making has substantial operating expenses and then a fixed rate of return, at least built into the revenue requirement as expected. You can construct many different models that could improve on this basic scenario. Um, some of them look quite different in theory, but if you look closer, there may be more similarities than you think. You can construct a rewards only model and a penalties only model that in fact operate quite similarly. If the rewards and the penalties are mirror images of each other, um, the key differences would actually only be the timing of revenue collection and perhaps some more subtle psychological differences. And with that, I'd like to turn it over to Rich Sedano for his thoughts.
Thanks, Mark, and hello to many friends out there who are listening today. The utility job is important, and as a firm, the utility gets distinct attention from regulators as it's affected with the public interest. And yet, of course, it's also a publicly traded stock, the investor-owned utilities are. How is a citizen to judge that utility bills are fair and that the monopoly is compensated fairly and that performance is good? The regulator has a toolbox it can use to motivate utility behavior and to attend to the question of, is there value for money in this service? The relationships that the citizens have a reason to expect. Explicit performance regulation is layered on top of a standard practice cost of service regulation. And this paper, in my observation, shines a light on both standard practice as well as the ways to do performance regulation and suggests ways that they can work better together. I'm most interested in how regulation influences utility management. If standard practice already provides a return on performance and that it is received just by showing up, perhaps we can do better in the name of the public interest. A breakthrough idea here, it seems to me, is that there is room for innovation by reducing the cost of equity and at the same time considering an explicit return on performance that's defined in ways that are aligned with the public interest, as distinctly defined in every state and for every individual utility. Perhaps a return on performance that exceeds the reduction and yields a value that customers will appreciate. So in other words, all sides can be better off. If regulation is meant to apply market discipline to monopolies, this paper shows how competitive firm analysis can replicate markets and can work. And lastly, I just want to say I wish I had this paper when I was a regulator in Vermont 25 years ago. Damali will manage the questions and answers from here.
Okay, thank you, Mark, Steve, and Rich. There are quite a few questions in the Q&A. I see some of you typing answers and responding to them. And so maybe we'll start with Steve, and I think you can see the questions, but we're getting a few questions around this kind of return on equity versus cost of equity. And in the registration, we also received a question around rate of return. And so maybe if you could address kind of topic broadly.
Okay. Let me start.
We'll clear up some of that.
Yeah, sorry, Damali. Yeah, okay. So let me start with the rate of return versus return on equity. The concepts are qualitatively the same. The rate of return is, and Mark had a slide on this, is the return on the debt and the equity, all the capital. The return on equity is just the equity portion, which is what drives the stock price. So the rules of value creation for if you're using return on equity are, as I said, the return on equity must be greater than the cost of equity. And its paralleling companion, if you look at all the capital, then the rate of return, that weighted average, must be greater than the cost of capital, which is the weighted average of what investors require. So the concepts are really the same, but some people like to look at returns on equity. Some people like to look at rates of return, but the ideas are qualitatively similar. Now we've got a bunch of questions here, and I'm going to see if I can sort through these a little bit. Okay, so Gerald is asking, well, he's got a good point. If the factor of time was included in the analysis, it might be clear over what time our impacts the market cost of equity. Well, the market cost of equity, that's actually a good point. It's always changing. It changes every day with changes in interest rates. It can also change with risk premiums. We're trying to talk about looking at something on average, like approximately what is going to happen. But in the real context, it doesn't change the principle. It just makes it harder to estimate these things. So things will change over time. Returns on equity tend to be more stable because they're set by the regulator, but costs of equity are bouncing up and down a lot. So there's a time dimension here, but what we see is utilities consistently trading above book value for year after year after year. So the conclusion that the ROE is higher than the cost of equity holds over time, all the way back to like the Ronald Reagan administration. So that the time doesn't change the qualitative conclusions. It might change some of the numeric conclusions. Now, this is the one I'm trying to, Steve's argument is confusing since investors hold the stock based on the dividends plus the change in the market value of the stock. That's exactly right. They don't hold it based on the ROE. They hold it based on the expected change in dividends and the stock price. So if the market value of stock rises based on future growth and profits, they'll be delighted. That's true. And that will actually make the expected return go down. The immediate increase in the price will make the expected return for anybody coming in, will drive it back to the cost of equity. This is a little slippery, but so let's say the utility gets an unexpected ROE bump. What happens? Well, the existing investors are happy because the stock price bumps up immediately. Now what happens? Well, it bumps up to the point where the combination of the dividend and the capital gain will add back up to 7.5%. There was a value proposition there. It was the existing investors captured the entire benefit of it. So they'll be very, very happy. The question is, will new investors who will come in down the road, no, they can't benefit from that because the existing investors have already captured it. I don't know if that answered it, but it's a good question because this is slippery. But you want to think about two investor groups: the prospective investors who really have a hard time capturing any benefit from an increased ROE before they own the stock, and the existing investors who will essentially capture all of it. So that may help to put them into bins.
I'm gonna interrupt you, Steve, because I'm gonna switch gears a little bit because we received this question quite a bit in the registration, and I see it has come up a couple of times in the Q&A. And so the general question is, how is it possible to implement performance-based rate making while cost of service rate making remains in place? And so I will toss that to Mark and Rich.
Sure. So I think the key is that under the existing legal requirements, you need to have some elements of cost of service, or at least some correspondence between the revenue requirement and certain elements of cost. There can be many ways to do that. And however, the obvious place to start with performance incentives is to look at that excess return on equity, the current gap between the actual approved and achieved returns on equity and a reasonable estimate of the market cost of equity. You can clearly use that gap and replace that with performance incentives, either penalties that reduce down or reduce base ROE and build up with rewards. It's a much harder proposition. There are bigger questions legally, how much further you can go than that to replace more and more utility revenue beyond that limit with potential performance incentives. So, under existing legal frameworks, which are particularly the U.S. Constitution, which is very, very, very hard to change, although the U.S. Supreme Court can do that from time to time. there tends to be the need to keep some of the elements of cost of service rate making. There are alternatives. There's other, like historic test year versus future test year. There's lots of ways to do reasonable estimates of cost in the revenue requirement. You know, but the key is that the existing performance incentives that we see tend to be very, very small, even compared to the sort of the excess return on equity that we see estimated by analysts and academics. So there's space to do, even within that gap, there's space to do a lot more than what we've done to date, and would be a pretty significant sea change. However, I think people have to understand that PBR is not going to be replacing 75% of utility revenue with performance incentives. So you have to just maybe moderate your expectations a little bit about what a full changeover to PBR would mean.
Well, Mark covered the question pretty well, so I'm just going to perhaps elaborate in a form of a metaphor. That I think of regulation really as the structure of a building, and the performance regulation is what the public sees when they walk down the street, and you either admire the building or you have problems with the way it looks. And I think if the public doesn't care what the building looks like, then everybody gets the same. But I think the fact is, well, the public does care how the performance of the utility looks, in the same way that you care when you're walking down the street how a building looks. And so you want the building to look good, you want the performance regulation to mean something. They can work together. And I think that's what we're saying is do both and make them work together.
So that's a great segue into one of the next questions, Rich, which is thinking about, and you mentioned earlier customer bills. And so thinking about how do performance incentive metrics help long-term affordability and equity? And so maybe address that for anybody.
Sure. So I think it's important to look at all of this as a package. If you're reducing base revenue and layering on potential rewards, you're not necessarily even impacting short-term customer affordability. Overall rates could go down. The interesting thing here is to think about how this all works together in the long term. If you're really trying to ratchet up better utility performance, you don't have to keep the targets and the performance incentives constant. You can keep asking them to do more, and you then capture that value for customers and society later on. So the achievement of performance incentives in 2024 shouldn't necessarily mean anything for 2028, and you should expect and set your performance incentives in a way that do not have low expectations for the utilities, but in fact continuous improvement. And you don't keep on rewarding them for hitting the same number. You want them to keep the upward trajectory.
Great. We have a couple of more questions in the chat. And so they're somewhat related. And so I'll try to summarize them. So one is about Steve's point on return of equity versus cost of equity. And essentially is that 1.5% difference you talked about is the marginal earnings of that performance pool that matters most with regards to influencing utility behavior. And then there was another question also thinking about the relative stock price and kind of related to that idea of long-term affordability, and ability for utilities to have debt service. So these are the last two questions.
So I'm looking at this question about marginal earnings. So that would be, just to make sure I understand this. So in utility regulation, unlike an investor firm where marginal earnings can be different from the rate of return that a company earns on its marginal project can be different from what it earns on all of its other projects. There's a multitude of returns. Each project could have its own return. In regulation, there's one return. We set the return at a fixed number, and when we're setting rates, that applies to everything unless the commission makes a specific adjustment. But so the question here is the marginal earnings the performance that matters? Well, I know ROE affects all of the utility investment. We apply that same number to the whole equity base. So unlike this is a good question if we were looking at, say, Target or some other non-regulated firm, then it would be all at the margin. That's where all the action would be. But in utility regulation, because we have a blanket ROE, essentially everything's at the margin when you're dealing with equity. So it's not just the marginal, it's the entire base. That's why a change in ROE can have a big impact because it affects the entire equity base. So I'm not sure if that answered that question, but that's how I'm reading it. Can I do one more, Damali, here?
Yes.
The one by, there's a good question by Chad about, he says timing about ROE equals cost of equity or a lower ROE. So he posits a hypothetical in which a utility files a rate case, and they're going to be the first one, say, in a state that's going to get a lower ROE. Even if they can eat, and the incentives aren't going to make up. Could they argue that they'll be at a disadvantage? Well, they can argue that, but they won't be. So think about how fast the market can react to this. So what do they see? In terms of a disadvantage of raising capital, no. Will they have a capital loss? Yes. So it depends on what you mean by a disadvantage. The market will adjust for the lower ROE. It'll reprice the stock down. Why? To the point where it makes the same return as it'll produce the same expected return on the stock of all companies in the market, the ones that have higher ROEs or lower ROEs. So is there a disadvantage in raising capital? No, because they'll offer the same return, but there will have been a capital loss. Again, separate the groups into two. Will new investors care that who haven't put their money in yet, that there's a lower ROE? No, they'll just it'll be priced out, and that's the Higgins, Koski, and Mitten thing. It all melts away. They don't care. Who really cares though? There's somebody that really cares, which is the existing investors. They've just taken a hit. Now they can sell the stock, and some of them will, and that's what will drive the stock down. But think about this. Let's say the commission ends up lowering the ROE to 8. Will anybody buy utility stock at 8? Absolutely. If you drop the price low enough, there will be people lining up for it. And so the pricing is going to take care of this. If you, by disadvantage, you mean at capital attraction, there's no problem here. But there's a big problem in terms of capital loss. So I think the disadvantage about capital attraction, none. But is there a problem? Yeah, there's an investor problem if there's a capital loss.
Great. Thank you, Steve. We have a question on, is there a difference between authorized, earned, and allowed return on equity?
Yes.
And I will send this to Mark.
So I think that was an elaboration from Janice on her previous question about specific mechanisms for management from investors. So that's an interesting question about how management operates. I think in modern corporations, public corporations, management do know who they're working for, and there's shareholder meetings. There's significant discussion about how to satisfy their existing investors, or else they often may get replaced. The interesting thing, though, is that shareholders, in fact, do understand incentives and how to align the incentives of management with their own interests, and that's through stock grants and stock options, right? By making management significant owners in the company, the alignment of management with the interests of shareholders could be quite good, in fact. So that's a common practice throughout corporate America in the last 30, 40, maybe more years. But that is one of the significant ways where across the economy where management's interests and shareholder interests are frequently designed to be aligned.
So Mark, can I jump in on that one too?
Absolutely.
So to answer Jan, my colleague Jan and I know each other very well. In fact, we wrote a book together. The difference between authorized, earned, and allowed, that's a good distinction. So what's the authorized return? That's the return that the commission used to set rates. That's really what its purpose is. It goes into the calculation, and let's say that's 9.5. The utility may earn more or less than that. That because unless the regulator perfectly forecasted the sales and all the costs and everything, that was one of my answers to that I typed in, is there's a lot of uncertainty as to what's actually going to happen in the future. So the earned return could be higher or lower. Now, the last point is a good one. And I think this actually comes from, I was talking with Jan about this from, I'm trying to remember his name, at the Virginia Commission. But the allowed return is something that we don't think about very much, but it's actually a good point. The commission can allow the utility to earn a return. Let's say the commission sets the authorized return at 9.5 and the utility earns 10.5. Well, the commission could allow the utility to continue to earn 10.5 if it doesn't call it in for a rate case. So that's a new dimension here. That shows that the regulator has some control. In some jurisdictions they can, in some they can't. But this allowed return is actually what the regulator will let, I'm going to say, the utility get away with. That's not actually quite right because it could be on the downside. But the allowed return is what the regulator will consider reasonable around the authorized return. Now that gets into earnings sharing mechanisms and all sorts of things. But those are three distinct returns, and people usually don't think of that last one, but it's actually important, and it's an important one, that the regulator may let the utility drift away from the authorized ROE for an extended period.
Great. Thank you, Steve. We have 1 minute left before the beginning portion of our webinar ends. And so again, I just wanted to review the key takeaways we talked about almost an hour ago. So looking at performance incentives and rate making holistically, we talked quite a bit about the incentives and the need for the incentives to be large enough. And we delved into that very deeply in terms of thinking about return on equity and how that influences the ability to be flexible with incentives. Also, again, there were lots of questions, comments around shareholder value. And then lastly, Mark wrapped it up with a focus on the legal concerns when thinking about this performance incentive approach. And so with that, I just want to again thank our panelists. Again, the full paper is available for download at our website, www.raponline.org. But if you have further questions or would like to engage with the authors, there is a contact us button on our website as well, or you can feel free to reach out to any of the RAP staff, and we are happy to help set up some deeper dive discussions. And so with that, again, for those that are able to stay on for another 30 minutes, there are quite a few questions in the chat. So we will try to get through some of those over the next 30 minutes. But otherwise, I appreciate you taking the hour to spend with us. And with that, I will just wait for 1 minute just for if people need to drop, then we can continue some of the discussions. All right, so there are a couple of questions, again, just kind of thinking around this idea of return on equity. So one is utilities keep on adding capital investment, including fast appreciating IT assets without actual customer growth or capacity additions, example, generation or transmission. Do you think utilities are relatively at a lesser risk than ratepayers as they are as return on equity plus tax plus non-cash depreciation? Is that the reason that the market is giving higher returns or premium than the cost of equity?
Let me jump in on this. Other people may want to. This is actually an interesting phenomenon that we're seeing. So if utilities can pretty much get their plant in rate base and then earn on the capital, get reasonable returns, there's not a whole lot of risk there. If the technology is, if there's not big cost overruns and things like that. And so that can explain why the cost of equity goes. That could put downward pressure on the cost of equity. But in the question is a really important point. They're adding capital investment without actual customer growth. That is actually, in the long run, is kind of a really difficult challenge, because what that means is you're going to just keep the rates going up. You're not spreading it over more kilowatt hour sales or therm sales. I guess it'd be kilowatt hour sales in this example. And at some point, that's going to make affordability a real challenge. Yes, we can do a rate making formula and plug in an ROE, and we can just keep adding capital. But if load doesn't grow, then the numerator is going up and the denominator is staying the same. By mathematical definition, that rate must go up. And so as the utilities are adding expensive capital in Wisconsin, in my jurisdiction, we have a lot of capital coming in. There may be a need for the commission actually to lower, this is an interesting aspect, lower, and there's been discussion of this, to actually lower the ROE. Because not for risk reasons, because remember, the ROE is really mostly not set for risk. That's the cost of equity. To actually lower the ROE for affordability reasons. So I'm taking your question and I'm pulling out what I think is the most important aspect. It's not a risk issue. It's actually an affordability issue. And at some point, it's not a limitless amount of money that ratepayers can afford, the customers can afford. So this could be a big problem coming up for utilities. They may actually face the prospect of lower ROEs the more capital they add, because that just keeps pushing rates up. So I would ask you to think about that. That, I think, is where it's a great question, but I think it's that assumption that's really the problem. The risk thing, I think, is not that big of a deal.
Great. There's actually a question that I think is worth, I know, I think she was typing an answer, but I think it's worth a discussion. So I'll phrase it as the question, which is related to what you were just discussing, which is, suppose a utility has a congestion problem and is offered two solutions, and one is a new substation that costs 14 million, and the other is a software solution that costs 800,000. How do you deal with what appears to be a perverse incentive to go with the more expensive solution because they will get the rate of return on that capital investment, but the customer suffers because rates will have to go up due to the new capital investment? And how do you protect the customer in this situation?
Well, I have an answer to that one too, but I don't know if Mark.
Well, why don't I start with the big?
I may turn it over.
Oh, you muted yourself.
Sorry, I will turn it over to Rich and Mark. I know Rich wrote an answer, so let's start with Rich, and maybe he can highlight that verbally.
Sorry, I was typing another answer. Can you focus me again? I'm sorry.
This is the question around the substation example.
Okay. Well, right. Well, look, this is just a great example for the things that Steve was trying to explain about cost of equity compared to the return that's set by the commission. If we really take the ROE that's put into rates and recognize that it's carrying a lot of weight to both deal with the cost of equity as well as to recognize the performance of the utility, but sort of like the grades of some elite institutions, you get an A just for showing up. So in the utility world, instead, what we could do is say, well, the cost of equity, you should get that cost returned to you in the same way that all the other costs in a rate case are included in revenues based on cost. So if you think of equity as just another cost, and then you think about performance as a distinct category of activity to consider, well, how does we want to motivate it? We want to use the return to motivate it. We want to use earnings to motivate it. How do we motivate it in a direction that promotes the public interest? And then we think about investment in smart systems, and we encourage utility to deliver results that are cost effective, then going to a less expensive solution, a more effective solution that can produce potentially a financial incentive as part of a performance system becomes a lot easier for management to say, let's do that, uh, than if they're in a situation where basically the performance part of their return is already assured and they don't really have to innovate in order to get it. So I think that it takes a mind shift to think about what a return on performance can really mean to the way that management and the staff within a utility think about their work.
Well, so I agree with what Rich said, but I'd like to emphasize and maybe zoom out a little bit. There are a million situations where the utility has a choice between making a capital investment or choosing some other set of expenses or just doing nothing. And there are many, many different ways that people have tried to address that problem over the years. Integrated resource planning is designed in large part to evaluate large investments in generation. But all these things should be looked at together. And performance incentives are important, can be an important part of the answer, but you still have to look at all these other options too. And there are lots of utility business model reforms that we quite like, and wouldn't want to suggest that performance incentives solve everything to the exclusion of some of those other ones. And you have to think of a good package of overall reforms, and you can keep innovating and improving things on multiple dimensions.
And if I could just add one point, I piggyback on what Mark said. Utilities in most jurisdictions don't have unilateral ability to make their capital investment decisions. The commission might tell them not to do that. And you know, in looking at a bundle, like Mark said, they might say, yeah, we know you make more money if you put the capital in, but we're just not going to let you do it. Now, that could be through a performance incentive, or that could just be by fiat. So we have to be careful that the utilities are not unilateral decision makers here. They're part of a process. And so some of those issues, if they're egregious, can be handled by simply not allowing the investment.
Great. We have a couple of questions from registration. So I'm going to pivot a little bit and maybe talk broadly about states where you've seen this model work or what hasn't worked in different states. That was a theme in several questions for those that submitted questions pre-registration.
So I think there's a good case that incentives have been productive, but the evidence has been more qualitative than quantitative. People who work in individual jurisdictions like New York can see all the places where utilities are working in certain ways on electric vehicles or other things that are incentivized directly by the PIMs, which are called earnings adjustment mechanisms in New York. Um, you know, in Rhode Island, I think the utility has been quite diligent about trying to achieve its a PIM for peak demand reduction, and earning that money. But the latest round of performance incentives hasn't really been evaluated yet, and a big part of our paper is flagging questions for further research within the right overall framework of thinking about these things. So.
Okay. Another question is, what do the panelists think about including incentive pay in the utilities revenue requirement? We routinely see that as a portion of the utilities incentive pay plan as relates to the achievement of operational goals, and another portion relates to financial goals, often weighted 50-50 between the two. Is it ever appropriate for customers to pay for the achievement of financial goals?
I have an answer if you want me to go. I'm waiting for you to call on.
Go ahead, Steve.
I would say it's never appropriate for customers to pay for financial goals, because those financial goals drive value in the stock market, and that's where the compensation occurs. So if you say, if you increase your earnings per share, well, investors will like that, and that'll be compensated in the stock price. So I can't think of an example where you would ever want customers to pay for financial gains. But paying for policy public service gains, then you might. I mean, that's really what we're talking about. Incentives here is compensation for doing something that is in the public interest, some kind of public benefit that's not recognized as a shareholder benefit per se. So we are going to actually we're going to convert it into somewhat of a shareholder benefit, but because through the incentive mechanism. So that's where I think at least there you can make an argument that those should be in there. Now, the incentive pay for management is a complicated issue in and of itself, but I think you can see the distinction. I see no case to put financial progress in the incentive. That would be double rewarding the utility.
Great. I know internally we have had many discussions about creating the objectives before creating the incentive mechanisms. And so several of these questions come both, I see one in the chat and one before around the objectives that we can use PIMS to achieve. And so one is around use of non-utility assets such as DERs, but also thinking about areas of reliability, greenhouse gas reductions, peak management. Do we have opinions or thoughts or recommendations on where this might work better or worse? I see Mark smiling, so I'm going to call on Mark first.
Well, look, I mean, I think the big takeaway from our paper is we haven't seen people take advantage of the full field of possibilities here. In terms of the policy areas, you know, I don't know if we collectively have a firm opinion on this, but I would like to see what is called bold, persistent experimentation. I think is one of the phrases that we really haven't. Until we get some more real, more significant efforts in this area, we won't really be able to evaluate this sort of a thing. So I know that may require somebody to go first, which feels risky. But I think they're putting together the package in a way that benefits, creates more winners than losers is the principle here. Where you can get the biggest bang for your buck is a little harder to say.
Steve or Rich?
I don't have anything to say on that, Damali, but I do have something on another question, but I want to see if Rich has anything to say about it.
No, go ahead.
Damali, if I can jump to the question in the chat about the interaction between, see if I can find it now, stock prices and debt. You see that one? Where is that?
Yeah, Gerald, it's the top now.
Yep.
Okay. This is an extremely complicated question and another good one. So this is a capital structure question, and he's right in the sense that the ROE affects, well, first of all, the capital structure issue has at least 5 variables in it: amount of debt, return on debt, amount of equity, return on equity, and taxes. And the fact that the return on equity and the cost of equity are often different brings a 6th variable in. But what he's talking about here is interesting, and there's not an easy answer. This really takes, and I'm actually in one of my research areas right now, a lot of analytics. When you change these returns and you change the weights, you change the overall amount that customers pay. That's actually a good point. But it's not clear. I will say one thing that we do know, that pushing utilities to like a AA bond rating, I want you to listen to this carefully. Let's push it to a AA bond rating, will lower the cost of debt, lower the cost of equity, and are you ready? And increase the cost of capital. Now, I don't have time to show you that. In large part, it's due to the taxes on the equity, that you have a bigger equity base with a higher bond rating. So you get some very interesting results in this. So this question is like a career. I mean, it is really a deep question, but it's one that regulators need to wrestle with. And I think this is another area where we don't dig deep enough. This is really requires some strong analytics. And my take is that this move to higher common equity ratios or higher returns is not worth it in terms of lowering costs of capital over the long run. But that's my first take, and it would depend on specifics. But I really like that Gerald's question there, because he's opened the door to another aspect, and the performance incentives will affect this as well. So this is not a simple problem that we have. It's actually quite a complex finance problem.
One question we received pre-registration is, are there any nuances for performance incentive metrics with vertically integrated IOUs versus non-vertically integrated IOU?
Well, yeah, a lot of the questions faced by those different kinds of utilities can be quite different. Obviously, if you're vertically integrated, you own generation and have responsibilities for managing and running those generation units. And if you're just a distribution company, you don't have any of those interests or responsibilities. So there's a couple different important questions. You need to incentivize different behavior from those entities, possibly, but also the costs and benefits of different actions to these utilities could be different. If you're only a distribution company, you don't lose anything if the overall generation requirements go down. So there are some both big and little differences to think through in constructing performance incentives for those different kinds of utilities.
Right. We have a question in the chat about prudence rulings. It seems to me that they are rarely used after the fact.
I think Rich wants that one.
Well, it's true that they're rarely used after the fact. They are often seen as almost declarations of war after perhaps many other violations of trust have occurred. And I think it's very important for regulators to be taking a straightforward look at how utilities make decisions, especially for very consequential decisions, to make sure that they've thought about all the alternatives and to assess whether prudence has been achieved. We hope that it always will be, but we know that sometimes there are blind spots in management, and so once you've found imprudence, the other big issue is, well, what do you do about it? Is it one strike and you're out? Is it 3 strikes and you're out? What do you do with that? And I think there's a discomfort to even get into that conversation. It's almost, like having deciding whether you want to bring up a beef with your spouse. You really have to think about whether you want to go there or not, and all the things that might happen next. But I think that it's the job of the regulator, as I've said before, to look at all the tools in the toolbox, and prudence is important. And you can only really assess prudence after the fact. You have to look at what the utility did. Once in my experience, in a room full of boxes, my office discovered a memo that explained how the utility management was result oriented and did not want to consider alternatives. That was imprudent, and that happened to be a pretty consequential matter, and so it affected significantly the subsequent litigation that I was involved with, as it should have, because that was just the wrong approach to a very important question. But I think there's an emotional part of prudence that discourages its use more than it should.
Great. So we don't have any more questions in the chat, and we have gone through the questions that were submitted pre-registration. So I will open up to our panelists for final thoughts, and I will start with you, Mark.
Sure. I want to go back and mention one thing from the slide where the animation wasn't quite right. That there were 4 principles for the incentive formulas that are underneath this lovely picture that I just wanted to mention. That for setting the incentive formulas, Our four principles are materiality. You need to be able to make a difference in the utilities incentives. Benefits commensurate with the overall costs. You have to look at the package and whether the amount you're paying is going to be worth it in the long run, and not take necessarily a narrow view of that. Constitutionality, you need to think about these legal requirements. And then clarity, the utilities and other stakeholders need to have a simple understanding of what is required from them and what can earn them a penalty, a reward, or avoid a penalty. Thank you, everyone, for sticking with us.
Thanks, Mark. Steve?
Yes, I would encourage people to look beyond rate case testimony and trying to, first of all, frame this analysis. You can see that if you looked at the Morningstar report that has the cost of equity at 7.5, that's not what regulators are saying, but actually that's what investors are saying. So at least to provide additional input to the process, think about what people are saying the expected return on the S&P 500 is. Not again in regulatory proceedings where we often see returns like 14%, but if you look at investment houses, or a firm like McKinsey or Kroll, or these people that do valuation for a business, they get returns, cost of equity for the S&P 500 of in the nines. Well, then the cost of equity for the utilities must be like in the sevens. And so if we look outside, we're going to get a different picture, and that's the way stocks are valued. So I think if you stay in the confines of regulation, you get kind of caught up in that really messy web of a mixture of finance and policy. And not that that's inappropriate, but it's not the entire picture. I encourage you to actually look outside at some of these investment firms that don't have an axe to grind. They're just trying to estimate those costs of equity as accurately as that's what matters to them, because they value companies. It provides an interesting insight, and I think it shines a light on where there could be better incentive designs. And thanks everybody for, if anybody's still here, thanks for listening.
Thanks, Steve. Rich?
Well, thanks. And there are a lot of people still here. I'm gratified to see that. Look, we want regulators to be successful. We want them to look back on their time in regulation, whether it's appointed commissioners in their several years, or staff in their several decades of work. And so we spend a lot of time thinking about the toolbox that regulators have, and we think about the difference between the outcomes that we want to see, and those outcomes are getting, I think, more interesting, more climate oriented, more customer oriented than ever, and what we are seeing, which is a consensus that progress is slow, and that regulation is often seen as a barrier to progress by a lot of people who are in the private sector. This is really an important thing to do, to try to rise above the routine and to think clearly about all the tools in the toolbox and how to use them as effectively as possible for the public interest that we not only need to see today, but the public interest that we're going to anticipate in years into the future. So my hope is that this will not only cause conversation about the content of this paper, but to talk about the thing that RAP always seems to want to talk about, which is regulation something that can be better, and how might we do that? Recognizing that in all of our states, it'll all be different in every one. There's no one answer. But what we do hope is that the answers will be coherent in each state and will meet the needs of those states. So I hope that we've helped to illuminate a path and illuminate the questions that are necessary to help the people responsible get there. So I appreciate everybody's attention this afternoon. Thank you.
Thank you, Rich. And again, thank you to everyone who is still with us. The questions were coming in, fast and furious, and so lots of really good discussion. Lots of really good insights by our panelists. Again, the paper is available for download at our website, which is on the screen here. And if you do have specific questions or want to further the discussion, please feel free to reach out to us. We are happy to jump on a call. Or if you are interested in performance incentive metrics at your state or energy office, again, we are happy to set up calls to discuss what that might look like for you. And with that, I hope everybody has a rest of wonderful day and rest of their wonderful. Thank you.
Thanks, everybody.
Thank you.